Welcome back. In our last video, we had a look at the consolidated statement of financial position and how we put together a complete statement of financial position for a group of companies. In this syllabus, the group of companies will simply be the parent and the subsidiary. Now, we saw the mechanics of the workings, looking at goodwill, NCI and group reserves or group retained earnings. And there is extra questions at the back of this chapter to help you practice those workings again. But now what I want to do is move on to some consolidation adjustments. And the one we're going to have a look at in this session is to do with intercompany trading. Now, imagine then that the parent and the subsidiary company have been trading with each other for a long time. And this would be before the acquisition. So let's say that the parent sold goods to the subsidiary and then the subsidiary paid those goods to the parent. Now, prior to the acquisition of the subsidiary, the parent and the subsidiary were both unrelated at that time. So the subsidiary would be the customer of the parent, and the parent is the supplier of the subsidiary. Now, if we then acquire the subsidiary, well, just because we acquire the subsidiary doesn't mean that we'll stop trading necessarily. The parent will still sell goods to the sub after acquisition, post-acquisition, and the sub will sell goods to the parent possibly as well, vice versa. Now, the problem that we have is that if the group companies continue to trade with each other post-acquisition, then that's going to lead to a number of issues. One of those issues would be intercompany balances. So let me illustrate this for you. So, intercompany trading then. Well, let's say then that the parent sells goods to the subsidiary after the acquisition of the subsidiary. And at the year end, the parent is owed $100 by the subsidiary. And therefore, the parent would recognise a receivable due from the subsidiary. Now, on the opposite side of the coin, the subsidiary is due to pay the parent $100. So, sub owes $100 to the parent. Now, the parent is its own separate legal entity, as is the subsidiary. So, in the parent's statement of financial position, included in their trade receivables will be $100 that is owed by the subsidiary. In the subsidiary's books, the subsidiary would recognise a trade payable due to be paid to the parent. And that's absolutely fine because they're both separate individual companies. So in their own accounts, in their own books, that would be absolutely fine to show that receivable in the parent and the payable in the subsidiary. But we're preparing group accounts and bringing parent and subsidiaries' assets and liabilities together. So, if we now think about this from the group's perspective, remember that invisible line around those two companies, the single entity, well, in reality, surely they just cancel each other out and net each other off. From the group's perspective, we have to ask ourselves this. Is the parent company going to receive cash from a company outside of the single entity? And the answer to that would be no. On the opposite side of the coin, will the subsidiary have to pay money outside of the group to an external company? And again, the answer to that is no. All that would be happening is money would be moving between the group companies, remember that we treat as one. So in reality, the receivable and that payable should not exist from the group's perspective, and as such, we must contra them out or cancel them out. So, if the parent is showing a receivable of $100 and the sub is showing a payable of also $100, we need to cancel them out and get rid of them for preparing the group statement of financial position. Again, the individual company financial statements will be okay, but from the group's perspective, we must contra them out. Okay, we must eliminate them when preparing the group's accounts. So, we need to cancel them out then, and we need to do a journal entry upon consolidation to cancel them out. And that will be back in your notes. So, to cancel out intercompany trading, what we do is we debit and reduce group payables. So to reduce group payables would be a debit entry. You're reducing the liability. And you're going to do that in the consolidated SFP. So do you remember when we consolidate current liabilities, trade payables, we take parent plus sub because all the liabilities are under control of the parent. Now included in the subsidiaries payables will be $100 that is due to the parent. We need to get rid of it and cancel it out. So what we would do is say, okay, well, parent plus sub minus the intercompany $100 that is included in the subsidiaries payables. And that's why we left the brackets open initially when we did our pro forma in the last session. We did parent plus sub, leave the bracket open just in case there's any adjustments. Well, here is one of those adjustments. If you see there is intercompany trading, take it off from payables for the group and also credit and reduce group receivables. So again, under current assets, assets are under control of the parent. So in receivables, you'd have parent plus sub, but included in the parent's receivables is $100 due from the sub. We need to get rid of that and minus the intercompany trading. Okay? And all we do is straight contra it out for the same amounts. Okay? And what that will show then on the consolidated statement of financial position is group receivables, which is money that we are owed from people outside of the single entity. And also in group payables, we will only show the amount that we have to pay outside of the group as well. And that's our first consolidation adjustment. Intercompany trading, the contra entry is that double entry, and you just minus it from receivables and minus it from payables. Okay, so what we'll have a look at in the next session then is if the selling company makes a profit to the receiving company. So let's say the parent sells goods to the subsidiary, but the parent makes a profit on those goods. We'll see that in the next session.